Per usual, living on this channel is for educational purposes only and is not intended as financial advice. It is Teaching Tech Tuesday. I got some questions about futures markets, the futures curve, how to use the futures data. So let's go through all that. This is going to get dense pretty quick. You may need multiple viewings if you have no idea what I'm talking about. Odds are you are already trading futures and you just don't know it. A perpetual future, for example. So I'll put all the links in the description of this video, but a simple definition is an agreement between a buyer or a seller to deliver or pay a physical good at a future date. This originated with commodities. It was one way to hedge out acts of God or create some sort of leveled off expected return, give you some sort of insurance that I could use a market or market dynamics to make sure I don't permanently go out of business every growing season, okay? These are derivatives, which just means it's not the spot market. It's not the physical market. It's underlying, or the underlying, right? Underlying would just mean physical goods, physical wheat, cocoa, frozen orange juice, whatever, commodity, whatever, crypto. All of this, here's the even more interesting part. All of these definitions are loose. They can change. So keep that in mind. Just because I say something is X doesn't mean it doesn't exist in a different form through financialization, right? We have cash settled futures on the CME for Bitcoin and Ethereum. Different exchanges have different collateral requirements that may be cash settled or coin settled or cash margined or coin margined. You can trade futures on anything. What's probably confusing to the non-commodity crowd is this expected delivery at a future date. You don't really have that with cash settled. So again, these are like loose definitions that are important to know the basics and then how that changes. So you can trade this obviously with anything. You can use leverage and margin, which is what most people are doing. Most people using futures markets in crypto are not hedging. They're just using the leverage and margin side of things. When you hear someone discuss open interest, you can think of that as total value. That isn't necessarily total notional value. For example, let's say we have an open interest of 10 billion. That includes leverage and margin to varying degrees, right? So let's say we have an exchange that lets us use up to 100x leverage. Most people on that exchange of that 10 billion OI are not going to be on 100x. On average, they're going to probably be on 5x, 8x, 10x or less, certainly. So you can get a rough idea of how much leverage is being used in a market based on the open interest. Nothing is ever set in stone. So we've had multiple exchanges in crypto over the years. We've had multiple different products from multiple different exchanges. We've grown into the traditional markets. Each market's going to have a different ticker, different open interest. Like everything is going to be different. That's why typically when you see open interest, it's aggregated. When you see funding, it's aggregated. It's across all markets, centralized exchanges, decentralized exchanges, and TradFi. You can split that apart, right? But to get a broad idea of what's going on, you kind of need to look at everything together. So when we say futures curve, what do we mean? I'll show examples of this. Futures contracts, or what they're called, have different dates in the future. You have typically your weekly, bi-weekly, quarterly, yearly. You could have as many contracts out on time as you want. We can have special dates established around a specific event. Like for halving, we can have, if we're the CME, we can introduce a special product. Again, not all products are going to have volume, people trading them, people that care. But for whatever reason, at whatever time point, someone will typically be trading them, assuming the market is big enough, right? And again, for different countries, you're going to have different currencies. So then it becomes even more confusing when you're trying to actually pull the tickers for this stuff, because the US gold futures market might be different than the Hong Kong futures market on gold. And that might be different than the Indian futures market, right? It's a lot. It's a lot of stuff. So keep that in mind. If you're ever trying to find a specific ticker, it takes some digging, but it can be done. So on the curve is just the time component. Typically what we see is a premium as we go out on the curve if we are bullish. So if we think prices will rise in the future, typically you see the weekly more expensive than Current price, the biweekly, more expensive than the weekly, and the quarterly even more expensive than the biweekly. If there is an event, if we think we are reaching a market peak, if we are bearish, if there is a global pandemic all of a sudden, we may see a downward sloping curve for specific commodities. I'm referring to oil here, where there might be a bearish future. Now that bearish future may be this week, it may be in the now, it may be Friday, right? That could be the bearish future. Or the bearish future could be, we think there's some El Nino event, or we think there's some issues in the almanac down the line with weather and climate and blah, 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 right? Then you could see changes in the curve based on weather expectations, based on growing season expectations, stuff like that. When people talk about hedging, they can do that with futures. Hedging is where you hold the spot or the underlying, the physical, and you sell the equivalent amount in the future. And remember, you can use leverage. I'll go through an example of this. Overall, you are net neutral, other than maybe storage costs for a physical good. But in the crypto side, we don't have those concerns. So you got to think physical first and then digital next, because that's how all this started. And what you're doing is you're locking in a specific value. So you're protecting your downside with no gain on the upside. So you're net neutral at that price, aside from funding or borrow costs, if you have those. There are other types of ways to capture market inefficiencies. Depending on the market, this will be called certain things: cash and carry, basis trading, funding, trade. You'll hear all sorts of different kinds of names. The basic idea is, let's say the futures curve is in contango or forwardation, which is my preferred way of understanding and remembering the futures curve. If the futures curve is in contango and you want to cash and carry neutral arbitrage, you can hold the spot and sell the future, so you're net neutral, and then you collect the premium. Reverse cash and carry would be selling the spot, holding the future, and collecting the premium, right? So you're net neutral on the actual commodity, coin, whatever, but you're looking to collect the premium between the future and the spot price. Or in the crypto example, you're collecting funding. In this case, it's probably called discount rather than premium, but I think you get the point. So perpetual futures, this is what most of us trade on the crypto side these days, I believe. Again, over the years, it's been OKCoin, I think, was the first futures contracts, and then we've got different exchanges trading perps over the years, and now even Kraken has a futures product. These have no expiration date. Another thing you may notice with perps is the volume or liquidity is greater than the actual spot markets. So for example, on Kraken, you may notice volume for specific coins with futures are greater. So you can get in and out easier. They are easier to trade at size, that sort of thing. The collateral can be in cash or coin depending on the exchange, right? All of these little things you can tweak as an exchange and say, okay, I'm trying to attract this sort of crowd. Or if you're a DEX, you have specific wants and needs based on the ability of users to connect with a wallet, right? And then there's the funding rate. So to keep the price of the perp close to the underlying spot price, the perps use a funding rate. And the rate is paid by one side of the contract to the other. And depending on the difference of the OI, it could be a lot of things, but usually it's if a lot of people are long, longs pay shorts. If a lot of people are short, shorts pay longs. So you may have noticed over the past 3 to 6 months, certain altcoins are very expensive to trade on the long side using the futures market because not a lot of people are trading on the short side, which makes sense if everyone is turbo bullish all the time and prices are going up. But one way you can see funding rates potentially remain lower is with a more sophisticated market participant who is using a funding trade. And this is where we get straight to something like the Athena protocol. But the idea here is whether or not you're positive or negative on funding, you can then hold or sell the spot or the underlying, sell or buy the future at the equal amount, and collect the premium, the funding, depending on the market environment. Now, generally, as we all know, funding is ultra turbo positive most of the time, or slightly positive most of the time. Most of the time, funding is positive. Most of the time, longs are paying shorts. And that's where something like, again, the Athena protocol has packaged this idea where we take this trade this arb trade, funding trade, cash and carry trade, basis trade, whatever, right? It's all sort of the same thing. Buy the spot, sell the future. They're staking ETH. They rely on positive funding. This could go sideways in a bunch of different ways, which may be low probability, maybe edge cases, but there are potential issues with tokenizing something like this. But it makes sense based on what we're seeing in the markets historically. And again, hedging is simple. Let's just get to the example. If you've got one BTC in a hardware wallet and you think we're near a cycle top at 100K per BTC, but you don't want to sell the Bitcoin, what you can do is use the futures market to hedge your downside risk, lock in that value. You no longer benefit from the upside. Let's say we go to 150,000 per BTC, right? You'd probably get margin called at that point, depending on your leverage. This is just one ultra simple example of something most people probably are never going to do, okay? But theoretically, you could do this. You could open a short trade using cash or stablecoin. You could even use the BTC itself. That would introduce volatility risk in the collateral, and that would change your margin requirements and your margin call level and all sorts of things. But let's say you had one BTC plus 20 grand. You take that 20 grand at 5x leverage, short the market, and then that locks in your value. If price goes down, the futures leg makes money while your HODL loses money. If the price goes up, the futures leg loses money while your HODL makes money, right? So net, no matter what happens, you're risking 20 grand for locking in a value, a coin value at 100, right? Additionally, because we know, again, on the perp side, funding is typically very positive, especially, let's say, 2025 or 2026, right? Like, funding's super positive. So you're going to get paid to be short. Now, the obvious problem with this is you do risk total loss of the futures side of the equation via margin call. Things get very volatile. So no one typically does this, but it's something you could do. You can also do variations on this type of trade with options. That's a whole other conversation. So those are some of the futures basics. Before I go any further with examples, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to our trading style. You can check out Kraken Pro with the link in the description of this video. Non-investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Payward Ventures, Inc., PVI, DBA, Kraken. We had some excitement with Gox coins on the move that aren't being sold yet, but are being moved. Price going all over the place. Something else to note with the CME futures, they are not open 24/7. So they are going to have gaps in price. The CME futures volume may or may not exceed global centralized exchange crypto volume. And so price may or may not converge to those gaps at any given time. So for example, Memorial Day, futures might have been closed, price might have moved X or Y percent. It didn't, right? We didn't really go anywhere. But let's say we were plus 10% on the day or something. Sometimes what you see, just sort of interesting market dynamic, you see price sort of sell down to the futures open price. And I'll put a ton more links in the description. Just real quick, the history of futures trading, as with most things, it started in Japan, trading rice futures, and it evolved in the US with cotton and CME. Now CME's got all sorts of stuff, but there are markets all over the world, right? There's the London Metals Exchange. There's all sorts of futures markets all over the place. And if any of this is confusing, the Khan Academy videos are great for explaining all this stuff. They're short. They're like 3 minutes, super compact, very, very good for the basics. There's also a ton of stuff on Investopedia where you can learn about all the other fun stuff. There's the massive Treasury cash futures basis trades where the Fed and Treasury is even worried about the amount of leverage in this seemingly free money trade. You can read all about that. And I put some links in there for perpetuals as well. So here's a look at a futures curve. This is, as you may immediately notice, not TradFi, not CME. There aren't even any DEXs on here. This is just one example of a website that looks at this, and we can see here's the index, right? Here's the perp, which would be the future without an expiration. And then we have the weekly, biweekly, and then some sort of date after that, monthly, quarterly, whatever, right? So you can see as we get out on the curve, we are currently very bullish. This will look different at different times. When FTX exploded, we may have seen the futures curve get super negative and super angry. You can think of this as a way to read sentiment. If we switch to the premium percent versus dollar value, this gives you some idea at how bullish we are, right? Are we too bullish? Are we too bearish? And that's where you sort of need to look at the historical levels where the market accepts that premium, where you still have buyers with premiums at 8%, 10%, whatever, right? In a way, this is the market sort of saying, we think price will be 8% higher in December. That might be a terrible way to think about it, but that's one way to think about it. And there's all sorts of fancy trades you can do and look at with all this, and there's more information on this site. We go to an extreme example, right? When we're thinking about math, I always like to think of like, what's the most positive and the most negative things can get. So as most of us have lived through the 2020 COVID stuff, oil seemingly went negative, right? It seemingly went past zero. What does that actually mean? Well, you sort of have to remember, because commodities are physical and having 1,000 barrels of crude, for example, takes up a lot of space. If demand plummets and there's no place to put 1,000 barrels of oil, because everybody has effectively said, I want to store my oil in this place, or this 1,000 barrels of crude is on some cargo ship already just waiting and sitting for demand, nobody wants to buy the oil, and there's no more space left. There's no place to put it. So in this ultra rare specific example, the futures price in that immediate future went negative, went to zero. There was just no place to put it. Nobody wanted it anywhere in the world. Everybody realized the world was shutting down. So like they say in the article, when they say it's minus $1, that means they'll pay you to get the oil out of there. Okay. And we can look at what happened during that time period for different instruments, different quality of oil refined in different places, right? There's all sorts of very specific type of things you need to know for this stuff, but eventually that normalized over time. And if we look today, this isn't an up-to-date version of what's happened with oil since then, but it's one way to think about, is there a supply glut? Are we in backwardation? Is that bearish? Or are we lacking supply? Do we think price will go up? And we can immediately, of course, think about what's happening now with cocoa and orange juice and wheat and other commodities where we're seeing massive increases in price due to scarcity, whether that be disease or weather events, right? And this is where using the futures curve, if you're a producer, is super important. In TradingView, under the Markets tab, if you go all the way down to futures here, you'll see overview and a bunch of different options. It'll pull up this screener. If you ever want to check a specific futures curve or a specific future, again, just to give you some idea of the number of markets here, right? There's ag, energy, currency, metals, interest rates, all sorts of futures, an infinite amount seemingly of futures. Okay. So just looking at the cocoa market, just to give you some idea of types of curves, like this is the current cocoa market. So it's currently saying perhaps that the worst is behind it in regards to supply issues or scarcity. If we look at the price chart, maybe this is speculation, pricing in lower prices in the future versus now, right? That also plays a part of it. Clearly, speculation was fueling this on the way up, along with fundamental reason and rationale why prices were going up. We can look at orange juice. This is specifically the frozen orange juice futures. That is still in backwardation, although the price still looks pretty bullish. And this is one way for producers to hedge prices in the future, right? So if you're a producer and you think the top is in, or it's good enough for your baseline cost, you are going to take action and express some viewpoint using futures. Here's wheat, and this is a different type of curve where it's initially in contango forwardation, then moves to backwardation-ish towards the end, and that may have a specific like growing season concern, right? We can look at gold. Gold is just up and to the right. There's generally been a bid on gold for all sorts of reasons. And of course the copper as well, other commodities, still very bullish futures curve, Bitcoin, very bullish futures curve. So this gives you some idea of maybe the sentiment, maybe the aggregate viewpoint of people expressing some sort of view on what they think will happen. It is not necessarily what will happen. It's just the market's logical conclusion based on the evidence. So did we have some massive shift in the futures curve based on GOX coins? No. We don't have a hard date on that. It's probably going to be by the end of the year. If we go out to 2025, nobody really cares about the GOX coins, okay? Like on the futures curve, that's not really a concern. CME also does basic videos on trying to understand what cash settled means using the reference rate. You know, if you're on a DEX, you're using a reference rate, probably tracked by Chainlink or some Oracle. So there's Oracle attack issues there, right? It's good to know what's my counterparty risk. Is there a custodial issue? What happens if the network gets busy? What happens if the Oracle and the price gets attacked, right? You don't want to ever have any sort of surprises. You don't want to ever ask yourself, you know, why can't I connect to MetaMask right now with XYZ exchange? Because what you'll notice is a correlation in volatility and blockchain congestion. Okay, so keep that in mind. Something that you're not going to experience on CME, right? But again, CME is not open 24/7. CME has different contracts. Here's the month, here's the expiry, different contract sizes. They have options. They have mini contracts as well. One contract here, I believe, is 5 BTC. So you can see how quickly that gets out of reach for most people other than professional, institutional type money. And the mini contracts are closer to what retail can trade. Historically, I used to track the futures dates, the futures contracts, futures expirations. I didn't know it at the time, but eventually what we came to realize was the half-year contract sometimes, or the quarterly contract sometimes, kind of had a specific built-in sentiment to it. Just looking at these white arrows and these past contracts and how prices reacted. Maybe it's pareidolia, maybe it's a coincidence, maybe it's just calendar stuff, right? Maybe it's just seasonality, but I think this is partly where seasonality comes from, at least earlier on. Even in the OKEX days, we had seasonality around the futures. So because futures expired at a certain date, you typically saw a top or bottom around that date on a quarterly basis. You'll also notice here that you've got multiple contracts running all the time, right? We've got 3 month, 6 month, weekly, whatever, right? It's all various time points. And because the CME has a lot of people with eyes on it, you're always going to see these inefficiencies get arbed away. But if we fast forward a little bit, you know, we got more contracts around the halving, and generally this pattern of price relative to contracts sort of continued to play out. I don't have an updated version to date, but a similar idea is probably even still happening, where the large institutional money generally isn't taking action on stuff probably in between the contracts, right? They're using the contract dates as a sentiment gauge. These do follow the calendar. This could be pareidolia, it could just be seasonality, whatever, right? But it all sort of talks to each other of when people are forced to take action based on futures and options, open interest, and expirations. So if you look at the current, just 2 contract dates that I pulled, January to July, April to September, you could say, well, are we at some market top or bottom relative to January and April? What do we think that may look like in July and September? Do we have some massive expiration coming up where someone wants to roll their contract forward or not, right? This is all sort of highly variable, subjective, in the weeds type stuff to think about. And it usually matters most at the extremes. You know, I don't think it's a coincidence that we took off after January 29th, after this current half-year contract opened up. That makes sense to me. So if you've opened along effectively on that future since the date, you're doing quite well. And you're doing quite well on the premium, because I'm sure the premium has helped you out a lot there as well. So this gets very complicated very quickly. And depending on how deep you want to go, you can try to glean some sort of discernible market signal. If we look at the historic OKEX futures premiums versus the Bitcoin Bitstamp chart, okay, the turquoise is quarterly, the green is the weekly contract. And what you'll notice when things got bananas in the banana zone in 2017, 2018, the quarterly premium just exploded. Now, this isn't a percentage on this chart, but we've never seen anything like that, right? Since then, we just haven't. markets change over time. They get more efficient, more players and money in the ecosystem. So we'll probably never see that again. But if we look at pre and post COVID, those premiums were roughly X, right? Whatever this level is, percentage is always better. If we look at in the bear market period, you can see how we sort of nestled into backwardation for an extended period of time. And only after getting back to 6K plus did we re-enter forwardation or contango. So just because the market is signaling backwardation doesn't mean that it's bearish. Just because it's signaling forwardation contango doesn't mean it's permanently bullish, right? This also helps you, in a way, figure out the crowdedness of the trade, right? If the premium explodes, there's probably max bullish FOMO sentiment and it's super crowded on the long side. Historically, again, if you look at the backwardation levels, we typically don't get into backwardation very much. Here's COVID, right? That's sort of the max backwardation level. There's other exchange dynamics that might change that slightly. And then you have times when the front week expiry is in more backwardation relative to the quarterly. Like it can get crazy all over the place, right? So it's just important to know, what are we today versus the past year versus historical norms, right? Like, are we crazy overbought, or are we still seemingly okay relative to premium? I'm not even gonna bother looking at the OKEX premium right now on the historic level, because that isn't really what leads the market anymore, right? CME leads the market these days. As far as funding for something like perps, for Bitcoin, you can find that on Look Into Bitcoin. They have a really good high and low resolution chart to look at. And what you'll notice historically, when funding goes super negative, usually there's a reason for that. Usually something is exploding, in this case, FTX, or usually there's some sort of not so good news going on, or just exhausted bearish sentiment. Again, we don't typically sit in negative funding. And pre-ETF was basically the current high in the 24-hour funding, aside from a few times recently. And that is a bit of a warning sign saying, look, we are extremely bullish. We have people paying X% every 8 hours, which works out to X% per year, right? Some crazy value. So there's automatically a time component on that. Either price keeps going up, or they will eat into their collateral and lose money. So typically this is a warning sign that we're a bit overheated. There's other websites, Coinalyze, you can look at funding rates dating back pretty extreme, just to get a sense of how did we look last halving versus this halving. Well, in 2020, December, we were almost maxed out on funding, whatever that is, 0.15, 0.25, I don't know. Aggregate funding was extremely high. Expectations were lofty, right? Just based on what the market is trying to tell you here. Versus now, funding is down quite a bit. I'm sure you've seen this as well from CoinGlass. Funding heat map we can see across multiple assets, typically smaller markets, more retail, gambling markets, more meme coin markets get super hot immediately, right? Very quickly. So to see funding rates come all the way back down in the cooler, lower cost zone certainly says we probably have reset the FOMO euphoria of February, March, and we're in a much healthier place based on funding at this current moment. With the CME data, they release what's called a Commitment of Traders report. That's a COT for short. And each week, we get to see which type of player in the market, depending on who you are, is long or short. We can use this again to see, is the market crowded long? Is it crowded short? What are the hedge funds doing? What are the asset managers doing? What are miners doing? So my guess is these hedge funds, they're not naked short, or they are not short here without holding underlying. My guess is this is some sort of arbitrage trade. So what we actually want to see is continued growth in the short side of this leg, because that means they are buying spot. Now they are net neutral. They are capturing the premium in this case. That's a baseline expectation. Let's say they are naked short. If price continues to go against them, they'll have to close that short, buy back what they borrowed or shorted against, and price will move higher, right? That's in effect a short squeeze. The same thing with the long side. Eventually we reach a point where on the long side, it gets a little too overheated and things tend to cool down for a period. So just another data point to watch in the periphery. If we want to look at the CME premium right now, as a percent. You can do that on TradingView. I'll put this in the description of the video, this equation. You can look at over time, what is the general trend of this premium? What has it been? What has been the market's accepted value? You can find some sort of average true range or something like that. This is the continuous front week, I believe. And then we have the BTC2 exclamation point, which is a further contract down the line. Similar to funding, what you'll notice is these premiums tend to blow out when things get turbo bullish, and then they come back to zero after sentiment wanes a bit. And we can zoom in, see this a little better. Since year to date, 2024, you can see each of these expire to the spot price. So that's premium decay. Sometimes it decays below the spot price, goes into backwardation briefly, sometimes not. Sometimes we spike really hard on premium for whatever reason. But my read here would just be similar to funding. We've cooled down a lot week to week, post ETF, right? This is pre-ETF. Pre-ETF, there was exuberance, FOMO, euphoria. That's cooled down a lot. We're back to baseline. So when you have these dislocations or inefficiencies or craziness going on, typically that signals things are getting out of hand and we're probably going to see a reversal, or there's an imminent reversal on the horizon. So we're not seeing that here based on that. And lastly, we can also stack up all of the futures contracts against BTC as a percent. And you'll notice each of these has a date and a letter preceding that date. That letter corresponds to a month, the number obviously being the year. So we can see all of the futures contracts and what the premiums are currently. And the way this sorts out, it should be a bullish curve. It should be a contango forwardation type of curve. We're not seeing any weirdness here. We're not seeing anything in backwardation per se. This is going to change over time, right? And I think this is most useful to most retail traders at extremes. Let's say we get to 100K, 200K, 300K. What does the curve look like? Is this lopsided? Is this bending in on itself, right? Are people hedging by shorting the long end in 2026? What kind of views are people expressing? What sentiment can be gauged from this? Something else to watch is also the CME COT stuff, because if the futures leg starts to get taken off as we get higher or as we reach some point, that could spell trouble for further highs potentially, which is sort of backwards of what you might think. So this is long. I know this is dense. There's a lot of stuff here. I'm sure I misexplained something. You can let me know in the comments below. Like, dislike, comment, share, subscribe, and happy trading.